Welcome to MC Pro Stock of the Day. I'm Stacey Pereira, and in this segment, we get you fundamentally strong stock picks that you could consider in your portfolio. Our pick for today is Equitas Small Finance Bank. Let me tell you a little bit of background about the bank. Well, it is headquartered in Chennai, and the company has completed its reverse merger with its holding company and is now aiming for a universal banking license. The stock has rallied considerably from its lows. In fact, in the past 8 months, the stock has risen by over 51% as against the 9% rally that we're seeing in the Nifty. But the important question to ask here is there more steam left? Investors may still consider Equitas as its growth continues to be quite strong. In the quarter gone by, that is a Q1 of FY24, its overall assets grew by about 36% on a YOY basis and over 6% on a sequential basis. And the key drivers is the micro lending as well as its small business loans and the housing and vehicle finance businesses. Disbursements too grew at a fast pace of about 47% on a YOY basis. This aided mostly by almost all segments, you could say. Now, the disbursement to the microfinance in particular, that business saw a rise of about 56% on a YOY basis, and to the non-microfinance, that business grew by about 43% on a YOY basis. Now, the company has also diversified its asset book, which will help it in its de-risking strategy. The share of the microfinance assets now stands at 19%. Of the overall 80% of the book is secured. A quick look at the asset quality then, which continues to remain quite resilient, with the gross NPAs stable at 2.6%, while the net NPAs are falling marginally to 1.12%. Now, provision coverage, that too has increased to about 58% versus the 48% a year ago. Now, the restructured book, that one, of course, is at 213 crore rupees, which is just about 0.7% of the gross advances, with NPA provisions now at 97%. Talking about the company's deposit growth, well, that is mostly led by the costly term deposits. While overall deposit growth grew by about 36% on a YOY basis and 9% sequentially, the YOY growth in the term deposits was about 73% of the CASA growth, which is barely about 1%. Share of the CASA, which is the low-cost current to a savings account. Now, this in the overall deposit has declined to about 38% from the 52% it was a year ago. When we speak of the compression in the net interest margin on NIMs, it seems like there is still some more pain left, as the largely fixed rate book, which is close to 83%, did not really benefit from the systemic rate increases. The costly term deposit too resulted in the rise in the cost of funds and thus impacted the interest margins on NIMs in the last reported quarter. The bank is now expecting some more deposit repricing and therefore has given a guidance of a lower NIMs in the coming quarters. Overall, we could expect a 50 basis point reduction in the NIMs in FY24. We are also expecting to see a gradual decline in costs. Now, this first quarter saw a steep spike in that overall cost, and thus the cost to income ratio shot up considerably to about 65%. Now, some moderation is expected through the year, though, in the costs. So, can it really deliver a decent ROA? Moderation in the credit costs along with some declines in costs should support the ROA in the vicinity of about 2% in FY24. As and when the interest rate cycle does reverse, the largely fixed rate book could also support the yields and protect or improve interest margins. Now, in the medium term, though, improvement in NIMs as well as falling cost to income, that would be the key drivers for the earnings growth. We expect to see a 34% earnings CAGR for the bank from FY23 to FY25 estimates, and the stock price will also be driven by these twin engines of earnings as well as the possible valuation re-rating, which is currently at 1.5 times its FY25 estimate, as the return on assets will stabilize to around 2%. With that, it's a wrap. Thanks so much for tuning in.